Don't do it, guys. Don't place trades based on what you see here. Please consult your own financial advisors and do your own due diligence. All right, with that said, let's go. It is quickly now. Quickly. Oh, September 9th. Got him. Sunday, 11:59. Um, oh, it just ticked. Ooh, got it in. Money. All right, it is now September 10th, Monday. So, just wanted to start this real quick before I ticked over. Uh, Now we have a fresh new blank chart. Yeah, yeah. So what I want to talk about today is the reasons as to why somebody would trade options. Why would they do that? What are some reasons? But first, an overall look at the market. Virtually no change as expected of the portfolio. Everything is the same because it was the weekend. No action, zero action. All right, so let's get into it. Why would I want to trade options? What are the reasons behind each move? So there are four things you can do besides strategies, but four main things you can do with options on Robinhood specifically. All right, and they are you could let's go to Apple for example here. Apple. What you could do is you can buy a call, you can sell a call, you can buy a put, or you can sell a put. Now, when you're selling and buying puts, I'm sorry, when you're selling calls or puts, it is important to note that you must have those covered in Robinhood. You need to sell a covered call and sell a covered put. What that means is need to have a collateral set aside just in case the option executes if it gets triggered. All right. So what that means is that, for example, if you sell a put, you are selling the obligation to someone else, the promise to buy a certain stock at a specified price. So let's say Apple, if I'm selling a put, a 220 put for Apple, I am promising that I will buy the stock at the designated date. Over here it says the date expiring September 14th. So on September 14th, no matter what the price of Apple is, I will buy it at 220. Unless the other party doesn't want to exercise that option. All right. There's no point for them to exercise it if the price is below 220, for example. If the price is 205, they don't need that. So that option expires worthless, is what they call it. And the premium that they paid just goes to the person who sold the option to begin with. All right, now selling a call. So that means that if I promise to buy, that means I have to put aside $22,000 in order to purchase 100 stocks of Apple because every options contract is worth 100 stocks no matter what the price of the underlying commodity is, I mean, or stock. So that's selling a put. Now, why would somebody want to sell a put? Selling a put. So let's say, for example, that as stated here, Apple is $220.33. If I sold a put at 220, that means that my reasoning is, look, I like Apple, but I think 220 and 33 cents a bit high. If it drops to 220 by September 4th, I consider buying it. So why don't I automate that? And in the meantime, I will receive a premium of $289 for my time, for waiting until September 14th to buy Apple at 220. Now, I might regret that decision because Apple might be at 205 by then, and I could just purchase them at 205 instead of having to buy them at 220, and I would actually take a loss if I decide to sell the shares, of course. So right now it looks like a great deal, but on September 4th, it might not be if Apple is at 205. All right. So that's my reasoning as why I would sell a put. So I want the premium, or I want to get a better entry price than it is right here, and I'm willing to wait until September 14th to do it. So if you click on the option, it will say here, break even. Where is the break even? It doesn't actually say it right here, but sometimes I think on the phone, Robinhood calculates for you what would be the entry price you'd be paying, including the premium that you collect from this option, including the $289. And that would be, somewhere like $3 less. So 217 or something like that, if my math is correct. If it's not, someone correct me, no big deal. Um, all right. Next, that's a good reason. Next, selling a call. Now, why would I want to sell a call? So, oh, it says the break-even price right here. Duh. Okay, selling a put. Yep, right here. Excuse me. 217 and 11 cents. I'm still new to the site, even though I've done like 30 episodes already. So now, selling a call. Why would somebody want to sell a call? You'd want to sell a call on Apple if, for example, you own Apple. Let's say I have 100 shares of Apple at 220 or 200, but I only want to do this with 100 of them. And let's say, for example, that I bought them at 220 like yesterday or at some point before, and I don't think that it's gonna go up in the short term. Okay, at least not as much as people think, or I just don't think it's gonna go to 230 by September 14th. I just don't think that. So that's called selling out of the money call, and you'd want to just basically you do it because you want to collect the premium. So you want to get that $78 for the next week of waiting for the privilege of owning 100 shares of Apple. But what you are doing is you're selling a promise, right? You're selling the promise that if the stock price reaches 230, I promise to sell you my 100 shares at that price. I'll do it, right? It triggers automatically. I have to honor that contract, which means that if the price is over, it could be not at 230, but it could be 250, it could be 240. So now I could have had Apple at 240, but now I'm selling it at 230. All for that measly $78. And I'd be selling it, including the premium. My sell price would be 230 and 78. So selling a call because you want to collect premium. Selling a put also could be because you want to collect just the premium. So we talked about a 220, right? If you are really bullish on Apple and you think there's no way that Apple's ever dropping below 210. I am certain of that. So what I'm going to do is I'm going to bet well, that wouldn't be worth it time-wise. You want to do something higher here. But let's say 220, right? I'm so certain that Apple is not going to drop below 220 by September 14th that I'm willing to put down $22,000 where my mouth is, and I'm going to collect that $289 for the next week for putting where my mouth is. Risky. I'm risking my money, my capital, my $22,000. It could drop in value quite a lot. I could lose $1,000 just if the price drops by 10 bucks or so. And I'm risking that for collecting that 289. Now, that's selling options. Selling options contracts, selling calls, selling puts. These are some of the reasonings behind why you would want to sell calls or puts. People do it as part of strategies too. There's all kinds of strategies. There's strangles, whatever you want to, There's what was it called? Where you stagger them. I forget now. But usually you want to do strategies on naked selling, not so much on these covered call Robinhood apps, all right, because it doesn't work well. You need to well, I'm not going to get into it now, but you don't want to do it on Robinhood. It's because you have to do covered. You don't want the strategies don't work well with covered calls um, and puts. So, anyways, selling calls, selling puts, simple. Now, buying. Why would anybody want to buy a call? This is the less complicated version. All right. So, if you think that Apple is going to go up, you can buy a call at any price, really, right? But some people buy them buy a call. Some people buy them like a little bit ahead. So let's say, because the price is cheaper of the call. Let's say I think that by September 14th, Apple will cross $230. So I go, look, I'm going to buy a September 14th 230 call. Boom. I buy this. And now what happens is somebody's on the other side of that trade, right? The person we discussed earlier, the guy who's like, no way, I just want to collect the premium. Apple's never going, it's not going to go to 230 by September 14th. And so they risk their shares against that. So now I purchase this call. If Apple does not go over 230 by September 14th, this expires worthless. So this $78 that I paid to that guy, he's chilling, he's buying margaritas and going to have dinner out with his girlfriend for that $78. Probably not in San Jose, California, or any major city, but somewhere away from there, you could probably buy dinner for that much. Over here, you buy Chipotle with $78, maybe before tax. So, you buy a call if you think it's going to go over to 30, and what happens uh, on September 14th? If the stock is, let's say, of 235, you can just purchase it at 230 and sell it at 235 and collect 5 times 100. That's $500. Or you can keep the stock. But the option is executed, right? Usually, I'm not sure. I think the Robinhood actually just gives you the money. It auto sells it on you if there's a lot of liquidity. So it just gives you the $500 and then you do whatever you want. Um, I may be wrong on that. Don't quote me. Not that it matters if I give you some misinformation though. But basically that's the gist of it. You want the stock to go over 230 for your contract to have any value. The good part about this is that you don't have to put up collateral. You just don't. You just pay that $78 and that's it. You're free and clear. It's like putting a bet down in the casino. All right, that's it. You're just betting. I mean, don't let the authorities know that I said that, right? They don't like betting in most of the country. Like think of it as gambling, but it's gambling. It's gambling. It's gambling. But we like it. It can be used as strategic in a strategic way. All right. So, for example, let's say you are short the market and you bought a bunch of SH, a ton of your entire account is SH, right? But then what you do on top of that is you buy some Apple 230 calls for the next week, and that way you're hedging your portfolio a little bit. So you have some kind of recourse in case your account goes against you. If in the short term your account loses a lot of value, but Apple goes up, I'm sorry, if your account loses a lot of value because you're short the market, but Apple pretty much is the market. It's one of the best companies in the market, and it goes up for the entire market. It blows through the roof. Then boom, you get some gains and you get to basically mitigate some of those losses that you have on your portfolio. So it can be used strategically as a hedge. You can use calls as a hedge. You can buy puts as a hedge as well. If you're long the market and you think Apple is going to underperform the market, you can hedge your portfolio by buying puts of Apple. And what does that mean? That means that if I buy a 215 put, a September 4th 215 put, um, I'm hoping for the price to go down for that. I I paid the $148, and what I'm purchasing is somebody else who's on the other side, the guy who we discussed earlier, who's selling the put. That guy is promising me to buy shares from me at 215. So if the price is 205, he has to buy them from me at 215. I can just go in the open market, and Robinhood does this for you automatically, I think. Purchase the 205 shares, and then sell them to that guy for 215, and boom, I've just collected $1,000 for just risking 148. Now, so you can gamble, right? You can say, I think Apple's gonna go down. So let's see how far, the rabbit hole goes, and you can purchase puts, which is actually what I have done. I've purchased the September 21st, it should say here. I think this one, 22.5 maybe. I think this. I've purchased one of these, and so that means that I'm already in the money, as you can see. I'm already winning on this trade, but we'll see if that stays this way for long. If it goes really far down, I might just cash in tomorrow and sell it in the open market and collect my profit. But I don't know if I want to wait for expiration for after the announcement. We'll see. But basically, you're betting for the price to Apple to go down. If you're bullish in the market, you think Apple is going to underperform the market, then you can hedge your portfolio with that put. All right, so those are some of the reasons as to why you would want to trade options. These are things that are not really available by just purchasing and selling stock. Right? It's really difficult, and on Robinhood especially, you can't really borrow, you can't really short in a traditional sense, which means that you'll be borrowing shares from someone. Let's say I borrow 100 shares, I sell them on the open market, and I pay somebody for renting those shares, and then I buy them back at a lower price and give those shares back. Okay, that's shorting in a traditional sense. But you can't really do that on Robinhood. So the best thing to do is to buy puts, for example. All right. Or you can sell covered calls really close to your price to collect a little bit of premium on a stock that you think is just going to fall a little bit, but you still want to own. So let's say I own Apple you know, I own Apple, but I don't think I'm pretty bearish on it short term, but I don't want to sell it outright. So I think it's going to go to, let's say, 217. So I would sell a 222.5 call for $420, and that will mitigate the loss from 220 to 17, and I might use the extra cash to buy some more Apple stock. So those are some of the reasons why you want to trade options on Robinhood. It's a really good way to cover both sides of the spectrum here. You can't really do that with just selling and buying stocks. And I'm really happy that Robinhood implemented this because I love the free trading. I love the free options. It's such a relief. They should have done this a long time ago. It's such a relief. It's so simple. It's so nice to use. Yeah, you don't get the percentage from money market accounts, which is what traditional brokers do, is they give you a small percentage. They put your money, cash, and available cash in the money market account, and they give you a tiny percent. I don't know, like 2, 3% or something like that, on your cash that's just sitting around. But Robinhood collects that. That's how they pay the bills. That's one of the ways they pay the bills. Let's just say that. They also sell gold memberships, and they also rent out stocks. They help with flow with other brokerages. They can, so sometimes you'll get interest from that. Like, let's see, if we go to account history, they give you that. Let's see if we can find that. Um, it's called, like, they call it bond interest or something like that. I don't know if I've gotten I don't know if I've gotten one lately. Zero dividends. Dividends. We can find it. We're gonna find it, guys. Don't worry about it. Dividend deposit. Dividend. Nope, nope, nope. Realty income. Pennant Park. Dividends and deposits, guys. I really want to show you what it looks like. There's a search button, but um, I feel like I should be really close to seeing it now. Coming up. In three, two, one. Still haven't found it. But the point is, they re anyways, I can't find it. Oh well, sorry. I have seen it though. They pay you for it. Some of the uranium stocks are really low, not very liquid, so they, they help with flow through other exchanges and stuff like that. But anyways, that's for Robinhood's model. I hope that answers some of your questions about why one would trade options. If you have any additional questions, or maybe I can map it out or draw it a little bit, I have a nifty drawing tool here. Ask away, and I'll be totally happy to answer any guys' questions, whoever's listening. I'm looking forward to tomorrow. Should be a volatile day. Maybe Apple will drop further, maybe it won't. Maybe I'll wake up early in the morning to figure out what's going on. Maybe I won't. But I'm really curious as what tomorrow shall bring. All right, well, that's it for today, guys. I hope you enjoyed it. All right, peace out.